Everyone, here we are with another video with Invest for Tomorrow. And to all the first time viewers and investors, welcome, and to all the subscribers, welcome back. All I ask for in return is for you to smash that like button to let me know you watch this video. It helps out the YouTube channel and it lets me know you appreciate the time and effort I put into these videos. So here we are with the topic that we don't like to discuss, right? The bearish stance, right? Or the possibility of a bearish moment in the market. So I have here the one-day chart for the S&P 500 index. I did a video a few days ago, almost a week ago and a half, almost two actually, not a few days ago, more like weeks ago, about the good, the bad, and the ugly, right? I told you guys that the ugliest this could get is 3,500 to 3,200. The bad is 3,700 and probably falling between 37 to 35. And the good is staying above 37, retesting that recent low right back at the beginning of March and running back up from there and having our W, right, recovery shape effect. So we are in the middle of obviously seeing that next line of the W, which this W could be that nice looking or it could be this ugly looking, which would be like up and then down and then up. What a ugly W, right? Something like that. And we got some things to look at. We got some things to consider, and I need you guys to be aware. Like, there's a lot of things right now that are just so confusing because today the big deal was, oh, hedge funds are moving out of banks. So remember, banks were rallying, right? They were like doing so well. And then all of a sudden, let me just look up Bank of America, which was one of the ones that, everyone was saying it was great. So all of a sudden, they've pulled back towards the end of last week, and they ran up today, and then it's still down, right? So it's been a little bit confusing. Then you also have here the other ones like JP Morgan. Let's see how they did. See, they're down a few percent too, right? It went down to like 148, ran back up. And I know this sounds like very little movement and stuff, but these stocks have room to fall when you look at that. So they're just getting started. I mean, they've reached the overbought section big time. So there's a lot of like possible pullbacks that these are S&P 500 index companies that are going to have an effect on pulling this down already, just like it is. And some of these recovery stocks too. So this is going to be a very volatile, confusing next 2 to 3 weeks and probably the rest of the month. So we need to stay level-headed as investors, right? That's the beauty of investing. You got to stay level-headed and focused. So it's a little confusing right now, but there's some indicators we could use that can give us some insight. So on the one day, it's showing room for the S&P 500 to possibly go a little higher, especially based off the history, right? We've seen it go up, at least touch the top of the RSI at the 70 mark, and the MACD go up a little bit more up to here, like around 60 mark, right? That's hypothetically speaking if it pulls upwards. But then when we go to the 30-minute chart, it's looking like there's room to pull back. A lot of room to pull back, actually. Like we're at the top almost, right? Ready for a rejection. But in the 30-minute, if there was to be a rejection like that, it would just fall back down to 39.16 or probably down here to 3,800. Nothing like down to the 37s or anything like that. So it won't be a full rejection, but it looks like it's time for it to come back down. So almost like anticipating, if it continues in that route, the next 2 days of the week, or probably the next 3 days, some turbulence, and at some point ending up lower and lower. We're going to have to see if that's correct. But I'm trying to look at the bigger picture here. And I looked at this article, and this article, it just threw me off. But I have to share with you guys, and I look forward to seeing your guys' thoughts. But I already talked about the good, the bad, and the ugly. I didn't think the ugly was possible. I don't even want to think it's possible. I don't even want to think the bad is even possible, right? Close to 3,500. But this article said a lot. So this is where it threw me off, which this is like, I don't know if it's a hidden message. I don't know if I'm reading too much into it, but let's read this together. So it says, The market is in a very healthy place right now, quote unquote, said Michael Batnick of the Irrelevant Investor Financial blog. In our chart of the day, Batnick shows that 93% of the stocks in the S&P 500 are above their 200-day moving average, the highest reading since 2013. Oh my gosh. I don't even know what that means, if that's good or bad. I need to see your guys' thoughts. Look at the graph. Look at exactly 2013. Look at it close to 93. And what happened after? What happened after? And look at 2012, where we were. Look at 2020, right? And look what happened right after, right? 2012 to 2013 at that peak. 2020 to 2021 at that peak. What happened after 2013? Please tell me. Please tell me. That right there is just, and it was slow. It took 3 years to bottom out. 3 years. Okay, this is based off the S&P 500 index, but if the S&P 500 index stocks right now are outperforming growth, tech, innovation, penny stocks, how do you think the whole market's going to do if the S&P is the one that right now is leading the game? Unless things reverse. I really don't know. But look at this. The peak. Batnick shows that 93% of the stocks of the S&P are above 200-day moving average, the highest reading since 2013. Since 2013. What happened after 2013? It dropped. And it dropped for 3 years. I really don't understand. I don't understand if this is good news. I don't understand if this is bad news. I really need your guys' thoughts on this. I'm probably reading too much into it, but, you know, very interesting to me. And they talk about a lot of other things here, and it was great information, but man, that graph is what stood out to me the most. And they're basically saying the year-over-year estimates are comparisons to 2020, when the global economy all but shut down and the company earnings were battered by the COVID-19 pandemic. More importantly, they do not justify a further rally in the stock market. Mali said something else is going to have to fuel a rally of significance. So they're saying that there's some stagnation in the market and we're due for a serious correction. But I don't know if these quote unquotes is sarcasm or just quoting Michael Batnick's statement. Is in a very healthy place right now. This is the highest that we've seen stocks above their 200-day moving average since 2013. 2013, the peak, boom. The bottom, 2012, 2020, 2011. And then it rose to 2013, 2020 to 2021. All it took was 1 year of a run and then 3 years of a bottom. Man, I don't know if we're going to go through something like this, 2010 to 2011, and then run back up, which is going to be wild and so confusing. Or we're going to go through, again, another drop like we just went through in 2020. Not as hard, not as big, but pull back a little bit and then just run from here on out. We'll have to see, though. We'll have to see how much of an impact it has because, you know, if I pull up the chart, you know, during 2013, it was falling, right? And it fell to 2016. And, you know, it was running up. The market was running up throughout all that time. And then right here in 2015, 2016, there was a slight correction. It wasn't nothing crazy. It was 2,100 to 1,700. That's 300 points. We went through a lot bigger than that last year. Almost 1,000 points. So if we're due for a small correction like that again sometime in the near future, let's just be prepared. Let's not be surprised. And I think it adds up to my analogy of the good, the bad, and the ugly. 3,700, 35, and the ugly, 3,200. I look forward to seeing your guys' thoughts down below. And as always, guys, let's make some money.